Today, I'm going to do a quick review of the first quarter of 2023 for our investment clients. I'm going to highlight a real divergence between stock market investors and bond market investors about recent events and what that means for portfolios. And I'm going to finish with an in-depth look at property. A lot of clients ask us about this and why we don't hold it in portfolios and why we don't tend to recommend it outside portfolios. I'm going to focus on a quick review at the start of the last quarter for our investment clients, where everything looks really serene. So all of our portfolios are up between 2 and 2.5%, and they've all slightly outperformed the average fund by about 0.2 to 0.5% over the quarter. So everything looks very much on track and what we would hope for and expect. However, behind the scenes, there have been some quite dramatic changes within the economic environment. So we've seen some big stresses emerge in the US regional banking system. So two high-profile bankruptcies, Silicon Valley Bank and Signature Bank, have led to people becoming genuinely concerned and deposits fleeing that system. The result of this is that people now predict that lending from the regional banks is going to be under pressure, and lending activity is very important for economic activity. And the regional banks are an important part of the US financial system. So the bond market is now predicting a recession, a quick additional 0.25% interest rate rise at the next meeting, and then a rapid decline afterwards as the Fed react to weakening economic numbers. So the bond market, the yields have all gone down and the bonds therefore have gone up. So far, so good. On the equity market, however, despite the fact that normally when there's a recession, equity markets will fall, equity markets have actually been quite strong as well as they react to what is still quite strong near-term economic data. Now, one of these two groups of investors is going to turn out to be correct. We believe it's the bond market investors who have this right this time. So we think actually we will have a recession, and we think that will lead to some equity market weakness later in the year. So to prepare for that, during this quarter, we've been steadily reducing our stock market investments, equities, and increasing bonds. And this should put us in a position to safeguard capital during what might be a slightly rocky end of the year, and to allow us to bounce back more quickly when the recovery starts. Property has been a mainstream investment for many people in the UK for a long time. A lot of people consider it to be the number one area they'd like to invest, and we get a lot of questions about it. As I've already mentioned, we don't hold it in our portfolios, and we don't tend to recommend it for people. The first reason for this is most clients already own a property. And they're already exposed to the UK property market through their personal main residence that they own. And quite often the value of that main residence is really significant as a proportion of their overall assets. So adding more to property doesn't make sense from a diversification standpoint. The second factor people tend to really overlook with property is the problem with illiquidity or difficulty of buying and selling. And that this problem isn't constant, so it tends to rise up during recessions. At the time when you want assets to control risk for you, property becomes very problematic. So it's kind of like the opposite of a risk-controlling asset. We don't like that characteristic, and it's very negative within portfolios. There are lots of specific risks within property that people don't really tend to consider. So we have things like regulatory changes. We've seen a lot of attacks on buy-to-let landlords, second homeowners, and I think because it's very political, these kind of things are likely to continue. We also see that property is very interest rate sensitive. As interest rates go up, property prices go down. Now, this applies to most investments. They are quite interest rate sensitive, but property is more sensitive to it than other assets. And right now, that's quite unattractive. And the last thing is valuation. So if we look at property generally, they're at very high valuations compared to historic averages. It's never attractive to buy things when they're at a high valuation. And there's a particular specific risk in property that I'd really encourage people to think about, and that is the planning system. So in the UK, properties are worth a lot more than their rebuild value because the land that they sit on is worth a lot. And the reason the land is worth a lot is because the planning system restricts what land you can build on. If at any point a political party comes in and decides to solve the housing crisis by liberalising planning, you are likely to see quite a significant fall in scarcity value of land, and that will have a big knock-on effect on overall property values. So you add all of these things together, property doesn't work well in portfolios because it adds to cyclical risk. It's interest rate sensitive. It's very highly priced relative to history. And you've got this sword of Damocles hanging over it at any point if the planning system is deregulated. I think people have enough exposure with their main residence. And for the time being, it's unlikely we're going to change our position and start saying that people should hold it within portfolios or outside of it. If you have any questions about any topic I've covered today, please get in touch. I'm always happy to respond to any questions or queries that people have. As always, I must remind you that I have been talking about investments and your capital is at risk. And if you don't subscribe to these videos and you'd like to, please click on the logo here and you'll automatically be added to our subscription list. Thank you.